Welcome back to the Women and Money Cafe. Hi there, Julie.
Hello.
You have myself, Catherine, and Julie today, and we are giving you everything you need to know to begin your first ever stocks and shares investment in an ISA. So this is for you if you've been on the fence, you know that you want to begin investing, you're not quite sure how to do it. So in this episode, I'm going to grill Julie and she's going to break down those answers for you into some easy steps so that by the end of this episode, you can go away and begin your first ever stocks and shares ISA investment. So I've built you up big there, Julie. This is just me being super curious. How long ago, Julie, did you open your first ever stocks and shares ISA?
Oh, now I know this because I think I've referenced this several times before in the Women and Money Cafe. And it was back in 1999. I just not long started in financial services and I got that saving and investing was a good idea. So I thought I'll go get myself one of those ISA things. And because it was on all the billboards, it must be good, right?
Mm-hmm.
Aberdeen Technology Fund back in 1999. Did not end well.
I think actually that is almost a perfect example of why episodes like today's are really important, because it's not easy, but we can be led by an advert or by marketing or by things that other people have said that worked for them. But we're going to add to that some of the things that we think you should think about before actually picking one. And if it's on a billboard, it's probably not the one. Do they even have billboards now? I mean, now we're in social media. Just if it's not in a little tiny post out there for you, it's probably because you should be looking at something else. So if I am going to pretend here, Julie, that I'm brand new, I've never invested in stocks and shares ISA. What would your first question to me be? What should I really be thinking about before I even click open the account and begin to buy that ISA stocks and shares?
Okay, so if you think back to the other episodes of the Women and Money Cafe that you've listened to, you know that we don't invest money without knowing what the point of it is, first of all. So being clear on what the purpose of the money is. So let's assume you listened to episode whatever number it was. Okay. And no doubt Catherine will pull it up in a minute because she's a genius like that. So you know why you're investing money. So the next first step is what's your time frame? How
Okay.
long are you going to be invested for?
Okay. So let's just say that my time frame was 2 or 3 years. What would you be saying to me then?
The shop is shut. You can't have a stocks and shares ISA.
I'm right. So too short a time frame. What should I be looking at?
Okay, so the shop is shut is a metaphor, by the way. All right, you can still go and do it. You don't think it's a good idea. So realistically, all the textbooks say that you should be looking at a time frame of at least 5 years.
Right.
Okay.
Okay.
But getting clear on the time frame might influence some of the next decisions that you need to make. So if you're investing for something that is in 5 years' time, that might influence how much risk you're prepared to take, as opposed to if it was something that you were investing for that had a time frame, say 20 years.
All right. So by understanding how long I'm putting it aside, that's going to help me work out how much risk to take with it.
Yes.
Yeah. Okay. Now, I remember when I began my own ISAs and cash felt super, super safe. But obviously, that's not going to generate us any growth. But I found this idea of risk quite off putting. I mean, even the word risk sounds scary. So, can you just explain to me, as the beginner, what we mean when we're talking about what our feelings toward risk are?
So I tell you what, I'm going to tell you what I tell all my clients when we have this conversation. Okay, in reality, the risk is not that we're going to lose all your money and it will disappear for forever.
Mm.
That's just not something that is likely to happen with the kind of investments that we work with. When I'm talking about risk, what I mean is that there will come a point in time where you might want that money and it might not be worth as much as it was last week.
Okay.
And then you have a choice. You either take the money out and you accept that drop in value or you wait. So the real risk is you have to wait for the money to come back up. The other thing I'll also tell people is it can go down in value. It will go down in value.
Yeah.
Right? You're going into stocks and shares investment, the value will go up and down. It's definitely going down at some point. Okay.
Yeah.
But it's going back up as well. I've never known it not go back up. But the real risk is time and waiting.
Yeah. So, I mean, that goes back to the very first thing you've said is you shouldn't really be knowing you want this before 5 years. So that is to allow that time. And it might still be that in the 5th year it's down. But if it's a longer horizon, there's more chance it's going to rise back up. And I think what I've always found strange is that the people I talk to often worry that that value is going to go down. But it's the same with our house price, isn't it? So whilst in recent memory, we haven't seen house prices go down dramatically, they have gone down. And people just hold on. So if you're in a position where you don't have to sell, whether it's your house or your investment, and you can wait longer, then you'll ride through until you're back in the black, so to speak. So, and I think that risk, it needs to be put like that, because there is also the risk of doing nothing, isn't there? Of just leaving it in a cash ISA. And that also carries a risk. Do you want to talk to us about that?
Okay, we're in danger of sounding a bit miserable here. There are no risk-free options. No, because if you've got money sitting in the bank, and let's say inflation is going to run at 10%, and you've shopped around and got yourself a stellar rate of 1.5% in the bank, your money's gone down by 8.5% each year, the buying power of it. So there are no risk-free options. So, but we're assuming if you listen to this one, you're on the cusp of wanting to make your first investment. So you're cool with that.
Yeah. So before we jump into the next thing on how to identify our risk, and we are covering off that if you're about to make your first stocks and shares ISA, that you do have cash in an emergency saving to use in the meantime. So how do I work out what my risk is then as a brand new investor?
Right. So it's about playing the game in your head. So this is really pessimistic, this bit, actually. It's about checking how comfortable you are with how much it can drop by. So it's looking at, right, so let's say it dropped by 10%. How do you feel about that? I don't like it, but I can handle it. Let's say it drops by 20%. It's all right. It drops by 50%. Okay, now I'm not comfortable.
Right.
So it's all about trying to figure out where your comfort level is with how much you can drop by. But there's a flip side to this with risk. So it's the loss side, but the other flip side to risk is gain, because with more risk, yes, there's more potential downside, but there's more potential upside. And if you don't take enough risk, then you're back to almost being in the bank where the money's not going to grow enough to be able to achieve what you want it to achieve.
So if I was to go and begin this, I know that there's a couple of options, which I know you're going to go into, but because when I talk to people, usually they say, oh, I think I'm a medium risk, or I'm quite high risk, or I'm quite cautious. Is that enough, or would you be encouraging people to explore that attitude to risk a little bit more?
I'll definitely explore it more. One of the places I would start, if you're trying to figure this out for yourself, is you'll have heard us mention before the Beam app.
Yeah.
So go and play Beam and identify what your strengths and what your weaknesses are when it comes to just overall attitude towards investment.
That's the only finance app that I got my husband even slightly interested in. He absolutely loves it, and he's not into money at all. But he found it fascinating. I think it's the insight on yourself, isn't it? And then you can start to apply that. I'd forgotten about that, so thanks for reminding me of that. I've got some money and I want to put it into an ISA. Tell me what I'm going to do now.
Okay, so your next steps, what you need to do is ask yourself, do you want to be hands-on or hands-off? Are you wanting to get stuck into this, understand it, play around with it? Or do you just want the money invested so it makes money, you don't actually have to do anything?
Okay, I know which one I'm leaning toward. But I think in fairness for everyone, we should probably cover off both. So should we do hands off first? Because that might be a shorter explanation. So I'm guessing you're talking something along the lines of robo advice, investment apps, or kind of ready-made portfolios, which are built for us in the first instance. And I pick, choose, and walk away.
Yeah. Okay, so you've got three options on how you approach this, right? So you can either get an advisor to do it for you, or you can get a robot to do it for you, which sounds sexier than it is, or you can DIY. So if you come to an advisor, the benefit there is that we are going to do everything for you. We take responsibility and you're protected to the hilt and you don't have to lift a finger. But we cost money.
Yeah.
So if you're not wanting to get involved with an advisor, okay, so the next step is if you want to be relatively hands-off, I think go and have a look at the robo advice offerings that are out there. And when we say a robo, like it isn't, like I said, it's not like some little robot's going to do it. I'm afraid it's an algorithm. So you've got lots of apps out there that will do this for you. And what they do is they ask you a series of questions. So they'll maybe ask you about experience that you've got when it comes to money and investments. They'll ask you about your time frame. They'll probably do a risk assessment on you as well. And they might ask you about any sort of ESG or ethical biases that you have. And then it takes all this information and then it spits out an answer that will go like, okay, you want the balanced portfolio. And here it is. And it's a pre-built portfolio that is built to sort of be in line with your comfort levels around investment and risk.
Yeah.
Is this making sense so far?
It's making perfect sense. And I think, and certainly as an absolute beginner, knowing me, would lean toward that, in that it's taken an element of getting to know me in terms of how long I'm investing for, some of the things that are important to me, and helping me select that risk. Am I low, medium, high, in whatever words it uses. And making a suggestion, can we use the word recommendation? I guess we can, to say that this might fit you. And then I'm trusting the research that's already been done. So I think as a starting point, it's possibly a really good point, and I would lean toward it. Obviously, some people are going to prefer the DIY route. So should we cover off some of the pros and cons of those before how to go about doing each of those?
Right, what we're covering off the pros and cons of?
DIY. Tell us about the DIY option.
Okay, so DIY is you're going to do it yourself. Okay, so let's say you're like, this stuff's really interesting and I'm right into it and I want to understand more. So what you want to do is you want to get yourself one of those investment platform things. Many are available. You've got Hargreaves Lansdown, you've got AJ Bell, you've got Interactive Investor, you've got Vanguard, which is a little bit different to them because you can only buy Vanguard stuff in Vanguard, but the other ones you can buy everything in there. So it's like, you've had Catherine refer to it before as a supermarket. So it's like an investment supermarket and you can go in and buy anything that you want. So the upside of the DIY route is you have complete control and so much choice. Because with the Robo, it's spitting out the answer and it says, here, you can have that one.
Yeah.
And you can tweak it sometimes, but you're getting this, whether you like it or not. So with the DIY route, you have complete control and the benefits are there, especially for like yourself, Catherine, know how you feel about certain industries, certain manufacturers, certain companies. You can screen for things like that. But the downside is you're going to have to do all the work. So you need to figure out what your asset allocation is, and I'll explain what that is in a minute. Then you need to figure out what you're actually going to invest in, and you're going to have to do the research.
Okay, so let's say that I found a little bit more confidence. Whilst the robo-advisor sounded like a neat option that I could maybe benefit from quickly, let's say that maybe I've started there and now I'm feeling a bit more confident. If I'm doing all that work, where am I going to find those kind of answers? Where am I going to go to find out about the funds and the bits that I'm meant to be doing in this DIYing?
Okay, so before we get to funds, what you want to do is you need to figure out your asset allocation, because in some ways I can't remember the research, but we all know it, that asset allocation is actually the thing that drives your investment returns, not the funds that you pick. oddly
Okay.
enough. So when I say asset allocation, so if you picture a pie and the pie has slices, and we've got an equity slice to the pie, we've got a bond slice to the pie, it might have a property slice to the pie, commodities, cash, and it's how you cut the slices of the pie that determines the risk of your portfolio. So if you've got 90% in bonds and 10% in equities, that's a very low risk pie you've got.
Okay. And if I'm feeling more high risk investing for the longer, then I'm going to want a bigger piece of equities in my pie and a smaller piece of bonds. Okay. And just to reassure anyone who's listening, that's already done in your Robo portfolios. So that the one they recommended will have a portion of equities, a portion of bonds, cash, maybe some property to match your. And that's kind of where they naturally correlate, isn't it? The higher risk you want or the bigger reward, the more you're likely to have in equities. So you don't have to worry about it with the Robo part, but when you are building your own or selecting a fund, and like Julie says, focus on, well, what's my asset allocation to make sure that matches your risk. Okay, so how have I found that out? Where would I go to find that out?
Figure out your asset allocation. I don't know if I meant to say this, but if it was me, what I would do.
I think you're allowed to say what you would do.
What I would do if I was trying to figure out asset allocation for the first time, there's broadly kind of two options you could look at, because I'm going to go and steal someone else's asset allocation is what I'm going to do.
Right.
So you've got the Vanguard Life Strategy 100% fund, or 60 or 80 or whatever the heck. All right. And if you go and look inside one of them, that's going to give you your asset allocation that you can copy.
Okay. Well, the 100's already telling me asset allocation. It's 100%.
But hang on. So if we take the 100 as an example, so Vanguard Life Strategy 100%, this is not a recommendation. This is a fund. If you go and Google it, you'll bring up the fund fact sheet and you can see how they've cut the pie up inside. So let's say they've got 30% UK equities, they've got 10% European equities, and so on and so forth. If you go and get the Vanguard World All Cap Fund, which is a similar risk to the Life Strategy 100 fund, you'll see the way they've cut the pie up inside there is slightly different. And they've got more of a weighting to the US than the UK. So if you go and look at the other funds that are point and shoot, and I'll explain point and shoot in a bit, you can see the asset allocation inside them. And the only thing that people tend to disagree on is whether they want to be more weighted to the UK or if they want to be more weighted to the US. That's personal opinion.
It is. And I might just go back to the BMAP, that if you're in the UK, you may have a natural bias toward having more UK. So I'm just going to backtrack a little bit just to make sure that I haven't got lost on the way here. So I've decided that perhaps I'm not going to do the Robo advice for whatever reasons. I'm DIYing. So I've got a platform, of which there are many, and you've named a few. I know I'm putting it into an ISA. I've done some research. I'm going to go for a long time. So I'm feeling relatively high medium risk. So 80% equities. Why can't I just have a point and shoot? Or can I?
Oh, yeah. We like point and shoot. Okay, so a point and shoot fund. I don't know if that's a proper technical term. It's like it's just built and it's ready, and someone's made the pie already for you.
Yeah.
So you'll go out and you will maybe see somebody's multi-asset, passive, balanced portfolio. That's a lot of bloody words. Right, but that is a point and shoot fund for somebody that's middle of the road when it comes to investment risk. So there's lots of these things out there. Every man and his dog have brought one to market since 2013. I won't bore you with the reasons why. So the supermarket is awash with these things. So you can just go and buy one of them. And then if you want to sex up a little bit, what we do is we could have what we call a core and satellite approach. Again, so the core is going to be your point and shoot fund. So it could be something like Vanguard or any other provider out there. And that's where maybe you'd have the bulk of your money. So maybe 80% of it would go in there. And then if you were getting really interested or you've got things that you feel really passionate about, you could take the other 20% and you could have little satellite funds dotted around your core that are all into things that you're right into. So one example is if you look at Pictet as a fund group, they've got all kinds of weird and wacky themed funds. So if you want to sex it up a bit, so the core is the thing that is going to make you the money and it's not going to go wrong. Because when we start trying to pick lots of different stuff ourselves, that's when we balls it up. So you want something big, stable, and boring in the middle. And if you feel the need to get a little bit exciting, that's when you use your satellite approach.
I call it my sandbox. It's almost like, here's the bulk of my sensible investing that's in some funds that are already multi-asset or match my risk, where the fund manager has gone and done all the hard work for me. And then I play in my sandbox with the little bit that I'm perhaps more willing to lose. If you Google point and shoot funds, I'm not sure you're actually going to get anything.
The technical name is multi-asset funds.
There we go. So someone's
risk-rated multi-asset funds.
Okay. Now, with a risk-rated multi-asset fund, can you just cover off for me the difference again between passive and active managed?
So you get two styles of investment management, and one is called passive, also known as tracker, and other is active. So with a passive stroke tracker fund, what it's going to do is we're going back to the black box against a robot. It's going to track the index of whatever it is. So if you go and buy a FTSE 100 fund tracker, this is a passive fund because it buys and sells things passively. If it's in the 100, it's buying it. If it wants the S&P 500, you're buying all of the S&P 500, and it buys all the indices around the world, and it doesn't react to market conditions or sentiment or momentum. It's not going to sit there and go all of a sudden, oh, we don't fancy holding this, we're going to sell it for that. It can't. It has to hold everything that's in the index.
Okay.
The flip side of that is you can have an active manager. And this is where someone is sitting there and making judgment calls and assessments of, right, okay, well, I don't like that company. I do like this company. We're going to sell out of this and we're going to buy that.
So one is following. That's its decision, the passive, and that's what it's going to track effectively, the index that it's named at outset. And that sounds cheaper to me. And then the other one, there's humans involved who are making decisions along the way and keeping movement, buying and selling in the assets or the equities. So when we hear those terms, passive and active, they're effectively just a strategy for managing a fund. Because I see often, and this is not a recommendation at all. In fact, what I'm trying to say is if you see it, don't believe it's a recommendation, that it's now become the answer, that everywhere you go on social media, TikTok just says, invest in a tracker, invest in an ETF, invest in a passive, but without all of the thinking that you've talked us through today. So it's got pros and cons. The other one's got pros and cons, but just because someone's told you it is the answer doesn't mean it is the answer. I like a bit of both because I think it's going back to diversifying, isn't it? That one might do one thing, one might do another. So have you got a preference or do you like to mix them up?
I like maths. I like the numbers because it's one of those quite polarizing arguments that one is good and one is bad. Okay, unfortunately, the data does not look good for the active managers. Okay, because you are paying them more and they're meant to beat the index and they fail miserably to do it often. So looking at the data, you're better off going passive, but caveat here. Okay. There are some asset classes and some sectors where an active fund manager will outperform the index on a fairly regular basis. The bulk of them, they can't. All right. So if you take like the US or the UK, they can't consistently beat the index. But if you go into like a different subclass, so let's say you wanted to invest in UK smaller companies, an active manager, if you get a good one, can probably beat the index. consistently.
Okay. And I still think a little mix and match still allows for all of, but it sounds less random the way you described it. So maybe for some things there's a passive argument, and for others there's a more active argument. So in terms of a checklist, then I've got my cash savings. I know why I'm investing. So this money I'm putting aside for more than 5 years for a specific reason. I've got a purpose attached to it. I've looked into, do I want to go down the advised route, the robo advice route, or the DIY route? So I'm imagining this in my head as a decision tree. If I've gone down the robo advice route, there are plenty out there. I'm going to just put here actually a good place for research for all platforms, including robo advice, is compare the platform. And it tells you all the costs, and you put in an imaginary amount that you want to save, and it will tell you and give you a direct comparison of which ones are looking at. So that is part of the research that you could do maybe to help decide. Or you can go down the platform DIY route. You could still use compare the platform to choose your platform on that. And then it's going to be roll your sleeves up and actually get really involved in finding out what you need to know about your risk, the funds, how they're made up, and their asset allocation. Have I missed anything in that recap that I've just done there?
No, I think that was fairly comprehensive. The only thing I would throw in is if you're a robo person, right, you can do it from as little as £1. So you can start really small. So I just wanted to throw that in. It's so accessible.
And I think that lends itself to, if you're doing something from £1, that we've covered this in all of the savings ones before, is this idea of do small. And this is a consistent thing. It's not just take a chunk of money and stick it in and hope. That what you want to be doing is regularly, consistently investing on an ongoing basis. So if you start with £1 and get more confident and increase to £10, £100, or whatever it is that you've got available that you're willing to put toward that purpose. I suspect that you've got a list there of, let's say I want to be robo. Give me some names of, these are not recommendations, but things you could consider.
All right, people, this is where you want to timestamp, okay? Because I'm going to rattle through a list of the robos. Okay, we have got Nutmeg, we've got Wealthify, we've got Money Farm, we've got Plum, we've got Wombat, we've got Doddle, we've got Free Trade, and we've got Trading 212.
Cool.
I may have missed some.
Yeah. Can I just add climb with an 8 for those who want the sustainable, and compare the platform, we'll have them on. So a little bit more, I think by the sounds of being a beginner, that the DIY is probably the one that you need to know more on. So let's say I've now committed, I'm doing the DIY route. Help me out, Julie. What am I now going to do as soon as this episode finishes?
So did you hear me loud and clear when I said it's the asset allocation that will determine how much money you make? It's not the funds. It's deciding how much am I going to put in UK stocks, how much I'm going to put in US. So that's the bit that determines how much money you're going to make. But then we need to figure out, okay, we've decided that we need to put X in UK equities. How the hell am I going to find a fund that does that? Is that a reasonable question that might be on your mind?
Yeah, I was kind of thinking there's a lot of how. So let's say that's what I'm looking for. Where am I going to find that? How am I going to do that?
Okay, don't look on billboards.
Or TikTok.
Or taxis. There are a lot of them on taxis. Okay, so step 1, ignore marketing. Because that's what suckered me back in 19, whatever it was. Okay, 99. So you want to do DIY and you've committed to put some effort into this. So you want a reliable source of objective data, which unfortunately is not exciting and it isn't sexy and it isn't a great story. It's just numbers. So the places I would go to for that is I would either go to Morningstar as a website or TrustNet.
Okay.
You go to these websites and you can start to filter and search the fund universe. So let's say that you were looking for UK company funds. So you can just go into the drop-down box, select that, and then it'll start giving you a big list of all the funds that kind of live in that sector, if you like. At which point you're probably looking at the screen thinking, what?
Yeah, because there's a long list. It's a very long list. Can I, if I'm doing that filtering things, that's effectively what I'm doing. I'm going to filter down and go for a list and then click on that and get more information with some pictures, not just numbers, on the asset allocation and where my investments are. Can I filter by things like, is it passive, is it active, or is it 100% equities, or is it, or even by risk? What sort of filters can I apply to kind of help me eliminate the funds that are not matching me?
Okay, you're not actually going to get that many filters to help narrow it down for you. I'm really sorry. I have lots of filters because I have the big expensive version, but you're accessing this for free. So I think it's just, first of all, knowing roughly what part of your pie you're looking to populate. Now, I suspect that let's say we go into TrustNet and you've put in UK companies, then it brings up this big long list and it'll have columns of numbers. And I know that you're tempted to go to the 1 year performance figure and click sort. So that it brings up the bottom with the best performance figures over 1 year. And you're like, I'll have that one. No, we don't do that.
Okay.
So what I would do if I didn't have access to the tools I have, I would maybe sort by 3 and 5 years. That would be an option because we want long-term performance. But it's not really the performance I'm going to look at. Okay, so the first thing that I always do when I'm researching a fund is I always look, there's a ratio called the Sharpe ratio. So I always want to know what a fund's Sharpe ratio is before I'll entertain investing in it. So it has to have a track record, minimum of 3 years.
Okay.
I'll be checking, so when you click into the fund, who's managing it and have they been managing it for that time period? Because if the 3 and the 5 year stats are stacking up really nicely, but it turns out they changed the fund manager last month, that's going to be a question mark for me.
Because arguably the performance that you've seen was based on the other person. And that might be about to change. Okay. I'm just wondering if this is the episode to talk a little bit more about Sharpe ratio, or shall we leave extra details and almost do like we did with the pension jargon, a bit of investment jargon on another occasion?
Catherine, they don't want a whole episode on Sharpe.
No.
So, should I see if I can do it in a sentence?
Go for it.
Okay, Sharpe is a ratio. So what it does is it figures out how good that fund manager was at making money when taking risk. So who is the best at getting the most return for the smallest amount of risk?
Ah, right. So this is going back to when we take higher risk, we have the potential of a higher reward. But this is, have they done, so two funds could have taken equal risk or had the same amount of reward, but one took more risk in order to get it.
Yeah.
Okay.
Uh-huh.
Right.
So it's telling me, you can look at the performance figure and that tells you how much it made. But what the Sharpe does, it tells you how they did it.
And are you looking for a positive, a negative, a small or a big?
You want a positive one. If it's negative, run for the hills.
Okay.
Okay. The higher the positive number, the better.
Okay. I want a big positive, a Sharpe. Okay.
The other number that I keep an eye out on that's going to help you when you're sorting through TrustNet is the volatility number. So it will have a volatility number. The bigger that number is, the more interesting the ride's going to be in the fund.
So if it was a roller coaster, this is how many ups and how many downs.
Yeah, so something with a volatility figure of 8 versus something with a volatility of 80. Right, the 81 is like scary. That is like one mega roller coaster. Okay. Whereas the one that 8 is like the teacups.
Right. Okay. I'm somewhere in between. I'm going to Alton Towers at the weekend, so I'll let you know in our next episode whether I'm teacups or nemesis. Okay, so in terms of DIYing, I'm on TrustNet or Morningstar. I've got some tools to filter to find out what I need for a little bit more fund information. I'm looking for long-term performance and another short figures. And I'm kind of interested in these two new concepts of Sharpe ratio and volatility. Or I'm just looking as I'm going through this TrustNet for some funds that are going back to this idea of just ready-made funds, point and shoot, which is not what they're called. Remind us, Julie, what we're looking for those.
You want a multi-asset portfolio. So they
Okay.
will sometimes be called like a balanced fund, a cautious fund, a manager of manager, or a fund of funds. There's a whole host of names for them out there. But as you're sifting through, you'll start to get a feel for it.
Mm.
But now that I've mentioned manager of managers, there's one really, really important thing that you want to keep an eye on when you're picking your funds. Right? Arguably more than the performance, more than the Sharpe, more than the no, not more than volatility, the charges.
Yeah.
Right?
Yeah.
Performance, we haven't got a bloody clue what's going to happen next. That's a guess. Right? The charges are the one thing that you can control. Do not want to be paying any more than you have to for something. So the charges is how much you're paying that manager or that fund group to manage your money for you.
Mm.
So if you're going with something that's a passive portfolio, you're going to be paying anywhere in the region of, say, between 0.4 to 0.5,
Okay.
0.5 max, right?
So yeah. So just to recap, this is coming out of your money that you're investing. So you've put your £100 in a month or £1, and then there is a charge. So we've got a platform charge, and what Julie's talking about now is also a fund charge. So I'm guessing from how you phrase that the active funds are more expensive.
They are, because you're paying someone. It's not a robot anymore, it's a person. And the phrase I used there was a manager of managers. So sometimes you'll get, so let's say you've got Joe Bloggs that manages the UK Equity Income Fund. So Joe needs to get paid for managing the fund. Then you've got Jane, who picks lots of different UK equity income funds. So she's actually put Joe in her thing. So she's got a fund made up of lots of different funds.
Mm-hmm.
That's a manager of manager or a fund of funds. So there are two people there that need paying. There's Joe and there's Jane. So that's extra charges. That's all right if they're making lots of money and that they're good at what they're doing. But
So okay, and again, I think with compare the platform, it will tell you what the platform charges are, but you need to be using some of those tools like Morningstar or TrustNet and going into the fact sheets and having a look at what the fund charges are if you're in the DIY camp. The Robo advice will have a charge, but then it should be showing you that at the point that you enter. If it's transparent, which it ought to be, it tells you what it's going to be costing you to go in. And I think the thing on cost is, it's important in that you don't need to be paying more than you have to, but it is worth making that cost because you're now getting access to potential growth in a stocks and shares ISA, that if you weren't paying the cost at all, you wouldn't be benefiting from that potential for it to fall and it to recover and to grow. So the costs are worth spending, but if you can get the same performance from one that costs less, then that's going to be a better one for you. You've got more of your pennies and pounds left in your investment. Okay, so we're coming to the end of the episode. So any last minute pointers for those who are listening, who are going to, at the end of this, go and do their research and invest their first £1, £10, £100 into their first stocks and shares ISA?
stick with it and be realistic.
Yeah, brilliant.
It will go down, but it will go back up again as well. You're not going to be getting 30 and 40 and 50% returns. Okay. Be realistic. Depending on where you're sitting on the whole risk spectrum, we should be averaging either sort of between 4 and 9%, depending on how much risk you're taking. Nobody ever says these numbers to you, right? So if you're at the lower end of the spectrum, you're looking to average about 4%.
Okay.
If you're at the other end, you want to be averaging about 9%.
So which compared to what it's getting in the bank at 0.4, and you're doing this for a long term, 5 years plus. I think my piece of advice would be just to start. I think whether you choose any of the options, whether you've gone Robo, point and shoot, DIY, just to have exposure, access to consistently add the small numbers up and become more familiar. So that confidence and familiarity and knowledge grows as you do that. So it's not like you've got to wait until you feel 100% confident that you know everything and then begin. Just start small. As Julie said, stick with it. Be realistic and consistently do that. And over time, you will start to see the rewards from it.
Perfect.
Thank you so much, Julie. Please, if you are listening and this has inspired you to go and put your first £1, £10 or 100 into Stocks and Shares ISA, or you've got any questions at all, you're just teetering on the edge and just need that, I was going to say nudge, but probably hug to get over the line, then drop Julie and I an email at the hello@womenandmoney.cafe email, and we'd love to hear from you.